Are you interested in potentially buying an investment property, but don't really know how to actually calculate to see if it's gonna make money every single month or lose money? In this video, I'm gonna walk you guys through step by step on how to calculate all the different expenses for investment property, whether it's a single family, multifamily, or even a condo, and see whether it's gonna cash flow every single month. I actually used this same exact method when I purchased my 3-flat over 3 years ago here in Chicago. And with this method, I actually calculated all the ones that were not worth checking out in person. And I ended up buying a multifamily that cash flows over $2,000 every single month. So this is something that actually does work, and I can speak from experience. In order to use this tutorial, you don't have to buy any kind of course. You don't have to give your email address, none of that BS. This is a video on just walking you guys through step by step. If you guys are interested in making more money or saving more money, make sure to hit that subscribe button down below. Also, feel free to give this video a thumbs up. Now we're gonna jump over to the computer and I'm gonna walk you guys through step by step on how to evaluate an investment property. And I have this Excel model right here. It may look a little bit complicated at first, but trust me, it is pretty simple once you get the hang of it. I like to run my numbers first before I actually check out any property in person to see if it actually makes financial sense to pursue the property with checking it out and then potentially putting an offer in. So like I said, this is something I actually been working on for the last 4 years. If you guys wanna download it, for free, there's no gimmicks with that. All I ask in return is to hit the thumbs up button. There's gonna be a link for a Google Sheets, and you can just download it and edit it yourself if you wanna run any of these numbers. So our first step with seeing whether investment property is gonna cash flow positive or negative is actually finding a property to actually evaluate. So I personally like to use Redfin. You wanna search the area. Since I live in Chicago, that's where I have my actual multifamily right now, and in the future where I want to buy another one. So once you have your city down, select what kind of property type you want. So we have our property right here that we're going to look into see if it's going to cash flow. It's a 3-flat, a legal 3-flat. We're going to run all the numbers and see what at the end of the year, how much money it's going to make or how much money it's going to lose. So first off, you just want to put all the basic information in the Excel model. So I actually like to put the address just so I can keep track of it, and it's a lot easier. So type of property is a multi-family. Number of units, we found out that's 3 legal units, and we found that out from National Listing. You can see right here, Avondale, Solid Brick, legal 3 unit. This way it's a lot easier to keep track. If you have a whole bunch of different, say, models that you're doing, it's a lot easier if you're saving them. So building costs, we know this is going for $600,000. Land costs, I wouldn't worry about that now. So cost basis model. So our mortgage, so right here, depending on what we want to put down as a down payment, you could adjust that right here. I personally like to put down as little as possible for my down payment. That way I could buy, set myself up for the next future deal. I'm always looking a couple steps ahead. I just don't want to be focused on the main one. So I like to put down 3.5%, 5%. There's special programs out there. But say if you want to put down 10%, or 20%, it's gonna update these numbers automatically. So let's just start, say we're gonna do a 5% down. So that means we're gonna put down $30,000 as the down payment, which is gonna be a $570,000 mortgage that we're gonna get on this building. So we have some of these ratios right here. The first one is loan to value. So it's basically what your mortgage is divided by the total cost of the property. So as you put down a bigger down payment, this number is going to be lower. So if you own more equity in the actual building, the number is going to be lower. You don't really have to worry about these numbers, but some people do ask. You may hear them, floating around in the real estate world. So I definitely think it's good to know. And we have our cash flow, so initial investment. So the cash flow or initial investment is basically how much we're going to be cash flowing before taxes, and then divide that by our actual down payment. So next up you have the cash flow for assets, and this is going to be your cash flow before taxes divided by the cost of the actual property. And then last up you hear cap rate, which is talked about pretty often in real estate. And that's basically just taking your net operating income and then dividing that by your cost basis, or how much you're actually going to purchase the property for. And this is used all throughout real estate. I would say out of all these, the cap rate is probably used the most often, so I'd pay attention to that. But you don't really need to learn these right off the bat. So we have our other assumptions. So we have our 5% down. Next up is how much our actual rent is going to be. The reason why I like using Redfin is most of the time it'll actually tell you what the actual rents are if it's an investment property with multifamily. So if you go down all the way, you can see right here, rent for the first unit is 12, so it's a 2-bedroom, 1 bath, and that's going for 1,200. Second one, 2-bedroom, 1 bath, and that's 1,200. And then last one looks to be the same as well. And you can tell right here, it'll tell you what the tenant pays for. So that's electricity, gas, and heat, which is good to know for our model later on. So go back to here. Does not have a basement or a garden unit, so 0 for that. So we saw right there, 1,200 for each of the units. So that means in a month, we're gonna be collecting $3,600 gross in rent. This is assuming that we are already going to do a 30-year mortgage. You could update that if this is gonna take longer. So say if you wanna do, or shorter, the 15 years, you could update that. I personally like to do all my investment properties on a 30-year. And then your interest rate, depending on this is something, I like to just kind of Google what the mortgage rate is to get more of a quick assumption of what the actual calculation is going to be. So usually I'll just Google mortgage 30-year rate. And I am going to leave links down below to all of them. So right now it's saying as of December 2021, on the 23rd, we're about 3.5. So just to play it simple, I like to go a little bit, maybe a quarter above. So maybe like a 3.3. So here you can see your actual payment, which is going to take into calculation your principal and interest. And this is calculated automatically. So as you update, your down payment, you see here that your payment is going to go lower. So it's nice that it's all kind of back end, and you just have to put in, your basic assumption numbers. Okay, now we have all of our assumptions out of the way. We're going to go into the actual cost to operate the property every single month. So we have our potential rental income, which is just calculating our monthly rental and then timesing that by 12. Pro tip, just because Redfin has the actual rent that it's collecting from the actual property does not mean that's the market value. By market value, this could be actually under. So maybe the market value is saying that this type of property actually rents for, say $1,400, $1,500. So no matter what Redfin actually says for the actual rents, I like to always back check it to make sure I'm getting the accurate numbers. So as we saw from those are 2 bedrooms, 1 bath. And I made sure it's in the same area as the actual property, just gonna see what we're working with. Usually I like to look at the same finish as the property that I'm looking at. Check Zillow, Hotpads, all the different rent websites out there, just to make sure that the property that you're questioning and valuing actually has true rents and what you think you could obtain. So sometimes, they might be high or low. Looking at different comparables, you could get a good estimate of what you think the going rent is going to be for the current condition. And then also I would see, what the new updated kitchens, with the updated appliances, maybe washer, dryer, what those rent for, just so you have an idea. If you were to put a certain amount of money in and update the actual property, how much you could actually get in potential rent there. You want to take into account vacancy. Your property is never going to be 100% vacant over all of these years. You have to take in some kind of vacancy. Even if you have turnover, you might have to, paint it, do some updates and upgrades to the property. So I like to play it on the safe side. Usually people say around 8% or so account for vacancy. I like to play closer to 10. My overall thought process is the safer you are with the numbers, and if you account for higher monthly expenses, that just means you have more room to play with, and it makes sure that you're actually going to make money at the end of the day. If you're just kind of budging these numbers, maybe you only account for 5% vacancy, the numbers may work at the end of it, but in return, I'm playing the worst case scenario, and then if anything better happens, it's just more money at the end of the month. And this is how I go through all my calculations, just playing it safe. So I like to account for a 10% vacancy. So if other rental income, so if you have like a washing machine, vending, parking machine, any of that, you could put any extra income. All right, since it doesn't have any additional income, we're just gonna put 0 for that. So that means our gross operating income is just shy of $39,000, which our gross operating income is taking all of our income that we're collecting through rent and other additional income with, say, washing machines or vending machines. So then you're subtracting out your mortgage payment and then also your interest payment, which is the one up here. So we still haven't accounted for all of our other operating expenses, which we're gonna go over next. So first one is gonna be real estate taxes. You can see here, it should say how much the real estate taxes were on Redfin. If we go through more details. All right, so you can see here the tax annual amount in 2019 was just shy of $10,000. So if you want to play it simple, you could just put that number in right then. But I also like to do sometimes, just because there's assessment years, so every few years the city can reassess the property and it could increase dramatically sometimes. And also, if you want to get the latest one, you could just kind of Google Chicago, or just Google whatever city you're interested in and look at the real estate property. So Chicago property tax. So you just put in all the property information from the actual Redfin page, click search, and it's going to pop up with the PIN number right here. So you can see the actual properties right here, and that matches. Yep, it's the same one. So you can actually see who the owner is. So the owner actually lives in the property. You can see the name, address, if they got exemption. It's kind of crazy, all the information you can find online for free if you know someone's address, if they're the homeowner. So now that Redfin only give us the 2019 numbers. Does that line up with that one? Yeah, so that's the same number. And then we have the 2020. So you can see a decrease, and that's probably because of COVID. It slightly went down. But for this one, usually it's 55% front loaded. They already pay the first half. So if I'm going to play this safe, I'm just going to say that property taxes for 2001 is going to be the 5,200 times 2 to play it safe. Usually it's 55% is the first one. But like I said, it kind of goes back to just playing it safe with these estimates and models. You rather overestimate some of the costs, so at the end of the day, if they're less than, it's just more money in your pocket. So we're estimating that the real estate property taxes are almost $10,500 for property insurance. Just to kind of give like a quick estimate, you should be able to get this from the actual Redfin page. So it's estimating $245 a month. So I'll just put that into the model. So about $3,000, which is pretty accurate. I would say right now I'm paying about $2,500 for my 3-unit multifamily. So I would say that's pretty accurate. So next up, if you're gonna have someone manage the property, usually you can find a manager for 5 to 10% that's gonna manage the property. I personally like to self-manage. That way I could save. So right here, you'd be saving almost $4,000 a year if you self-manage. Plus, especially for your first rental property, you do gain a lot of experience and background knowledge if you self-manage. So if you plan on having a manager, I would put in 10, but I'm not gonna, so I'm just gonna put in 0 for that. So I like to account for about $50 per unit in repairs on every single month. Certain months you may not have anything, say for 3-4 months that needs a repair, but all of a sudden you might have some items that, whether it's a door, window, smaller items that need to be repaired. So you definitely want to take into considerations within this model. Since this is a 3-unit, it's actually multiplying the 50 times the 3 units for the 12 and then 12 months. So we're calculating about to be $1,800 in actual repairs throughout the whole year. I also like to take into account accounting and legal. I know when I gain another property, it's gonna cost me about $350 more with my accountant. This is a small fee, but it is something to consider when you buying a property. You want to take into account all of your expenses. So now we have PMI. So if you're paying less than 20% down, you're gonna have PMI, which is just another insurance. So if you have above 20%, I would just put 0 for that. But if you have more, usually you can figure it out from here. So if we're only planning on putting 5% down, the $30,000, it's calculating that we're gonna have a PMI of 356 a month. So just update that, 356. So about $4,200 a year in PMI. Next up, garbage. For Chicago, it's about $50 a month or so for garbage. If you're unsure what the area or town you're in charges for garbage, I would just do a simple Google search. But 50 is play it safe. Nothing for supplies. So for groundskeeping, just looks like there's a little front yard. So for this one, I would probably, if I'm self-managing it, I'm probably gonna put 0. But if you're not gonna self-manage, I would take into account someone actually mowing the lawn. And then in the winter months, you actually have to take into account someone shoveling it, especially if it's a multifamily. It's a single family, I would put 0 for that because whoever's renting it out, it's their responsibility. So since we're self-managing, $0 for that. Remodeling. So if you're planning on remodeling any of it, I would take a look at the pictures. The pictures here, like there's some of them, like the kitchen right here, could really use a remodel. And one thing to take into account, if you remodel it, you're gonna be able to get higher rents. So the kitchens are pretty bad. One cool thing on the actual Excel tracker, there's another tab for rehab costs. So if you want to get a kind of like a rough estimate of what hiring it out, say for like a kitchen gut rehab, 12,000, maybe if you do it yourself, you could get kind of estimates here. One thing to note though, say if you are planning on doing a remodel, you could, potentially increase the rents. So for this property, maybe if we do update one of these kitchens that are really outdated, maybe that, that costs us, we hire it out for 12,000. But instead of getting, $1,200 in rent, we could potentially get, say, $1,400, $1,450. So we could kind of mess around with the numbers and see, what works in our situation. But for now, we're just gonna leave it at 0. So for gas and electricity, in the listing, it says that the actual tenants pay for both of them. So that means the actual renters are gonna pay for all that. So that's not gonna cost us anything. So that's gonna be 0. Same with electric. And then for water, so like I said, every city is different. It is common in Chicago for whoever the property owner is to pay for the water, even though the tenants pay for gas and electric. Like I said, it kind of depends on every city, but for Chicago, that's pretty normal. So CapEx expenditure is less. So what this is, say if you need to replace the roof, maybe some major water line breaks. This is taken into consideration those big expenditures, and even though this may not happen every year, you still want to save up and account for those in your expense model, and that's why we're doing it here. So on average, I'm accounting for about a 4.5% assumption for my CapEx, and like I said, that's just playing it safe. So this way you have a little bit of money of a cushion every year, and we're accounting for in our repairs and maintenance with the CapEx. About $3,500 are going to go to making sure the property is up to standards and making sure that it's safe for all of our renters to live in. So if you calculate all that, our annual operating expenses for the whole year is just shy of $24,000. So our net operating income, if you subtract the gross operating income minus all the operating expenses we just calculated, we're about just shy of $15,000. Then we're going to subtract out our actual payment for the mortgage and for the interest. So for the year, both of those are going to be just shy of $30,000, which means before taxes, we're actually going to be losing about $15,000 with this property. We can take into it back, the principal pay down. So our renters are actually paying down our actual principal, our mortgage, every single payment with every month. So in total for this property, we'd be paying down the mortgage about $11,000, which means I'm increasing my net worth about $11,000. So the last line is depreciation. So if you depreciate your investment property, you could use it as a write-off. I think that kind of skews when you're looking at the property, so I actually don't like to account for depreciation. So that means my total net income or loss for this property would be $3,900 per year. I actually like to look at the cash flow before taxes, just because I like to look at this as the gravy on top is paying down my principal. I don't want to take that into account when it comes to potentially buying a property. So what I'm looking at right here is the $15,000. So for me, I like to make sure that my properties are cash flowing positive. So with all these assumptions, I would actually pass on this opportunity as it is right now. But like I said, there are some ways you could get creative about it. Say if we did actually, improve that the kitchen and we got rent to be, $1,450. So that does help out a little. So now we're just shy of about $12,500 in losses per year. Maybe we did that to all of them. So even if we updated the kitchen on all of them and spent $36,000 in total to update 3 kitchens and then update the rents to $1,450, it still looks like we'd be operating at a loss, $7,000. So even if we were to do upgrades to this property, I still don't think it would be worth pursuing. And this kind of just helps us out so we can see, play around with the numbers, what makes sense. And then from doing this, I know that this actual property right here is not worth checking out in person. And once you get the hang of this down, maybe this only takes about a few minutes to fill out. But at first, it may take a while. I personally think it's fun just to mess around with the numbers, see what situations would make this better, make it more profitable. But it's just, again, just playing with those numbers. And over time, it could just take a few minutes just to update this. There you go. That's how you check to see if a potential investment property is going to cash flow. Like I said, you guys could download that Excel for free down below with the link. If you guys did enjoy this video and it did help you out in any way, make sure to smash that like button. If you guys are interested in how to make more money or save more money, make sure to subscribe to this channel. I'll see you guys in the next one. And this is Kevin, your financial tutor, signing off. Peace.